Hi, everybody. Welcome to our pop-up session. I am Ashley Kerr, and today I am with Anthony Michael, and he's going to be talking to you guys about hard money lending. Do you want them to call you Anthony or Tony?
I think Tony's fine.
Okay.
How's the audio on the mic? Everything good?
Yeah, good on the side. Yeah. I don't even have my mic connected right now. Right before this, I was on a podcast recording. I was being interviewed on one and I was just like kept going in and out. So I just unplugged it. So.
Yeah, normally you have a gold mic in your hand.
Yeah. I think I've like collected like 5 different microphones now, but
yeah, try to find the one that works the best.
Yeah. So Tony, do you want to start off just telling everyone a little bit about yourself? Tony was actually just recently on the Real Estate Rookie podcast too. So if you guys want to listen to that or watch it on YouTube, you can find out a lot more about him and his background. And so he's a hard money lender and also an investor too, which I think is great that he has knowledge of both. Tony, do you know what episode number it was you were on?
I think it was 147.
Okay, I'll Google it real quick.
147. Yeah. So brief introduction about myself. Thank you guys for joining tonight. I know everyone's probably just now getting off of work, getting the kids situated, cooking dinner. Appreciate you guys hopping on and listening to me and Ashley speak. Quickly about myself, background, currently active duty military, 28 years old, stationed down here in Fort Lauderdale. I've been investing for about 3 years now. It took place in January or February 2019, where I went into business with another military member, which was pretty cool. And we completed our first flip, made 100% return on my money, and I was up from that point. So moving a little bit forward into the future, we're on our 16th, 17th, and 18th flip now. I've completed about $50 million in real estate transaction or hard money lending transactions. And just excited to be here and talk to you guys about hard money lending today.
Tony, do you want to tell them a little bit about your background as to how you even got into becoming a hard money lender too?
Yeah, absolutely. Thank you for that, Ashley. So when I was stationed back in New Jersey, 2.5 years ago, I was currently renting from someone in Absecon, New Jersey, just a private owner. And we had just found the Bigger Pockets podcast and hard money lending. And it was kind of one of those things where I wanted to get into it. It appealed to me a little bit. It was interesting. I didn't know all the perks and benefits to hard money lending or how to apply it to real estate investing. So I got home from work one day and I was taking out my trash, and my next door neighbor was outside smoking a cigar, watering his his flowers or whatever. And I said, "Hey, I haven't really formally introduced myself. I'm right next to you, and just curious, like, what do you do?" I don't know why it popped up as to ask him why he was watering his garden and what he does for a living, but it just seemed pretty odd that he was home at 1 o'clock smoking a cigar, watering his garden. So he told me he was a hard money lender. And I was like, man, that's so cool. I just started learning about this on the Bigger Pockets podcast. And I'd love to learn from you. And he said, yeah, sure. Come on over. Whenever you're not busy, and we'll walk through it. You can take some calls with me and we'll get you going. So I was like, okay, cool. So I didn't really know what to expect. So I just walked in with an open mind and started taking some of his client calls that were coming in about hard money lending requests and negotiating with the clients over the phone and analyzing deals and numbers and requirements and all this other stuff. It was so interesting to me. And I actually closed my first hard money lending deal with him. And I made like $480 or something. That was the coolest thing ever, that I could just pick up a phone and make money off of funding somebody's deal. So that's how I got into it. Now stemming, projecting into the future, the $50 million came from me partnering with a different company. I moved away from New Jersey and ended up partnering with a different company who I brought to Bigger Pockets. We created a lead gen funnel on Bigger Pockets, and we became the #1 rated hard money lender across the entire platform in the 2 years that we've been on it. So it's really, really cool. And then $50 million in transactions across the entire United States, from commercial to single family rentals, Airbnbs, you name it, we've probably funded it. Most recently, we're doing a $14.5 million ground up construction deal in Marathon, Florida on the water, which is super cool. And then a $6.5 million mixed use commercial refinance in Seattle, Washington. So all really cool stuff. And it's cool being a hard money lender now that I can talk to different investors from around the country and get their perspective of their real estate market, how they're investing, how they're tackling their deals, how they're finding their deals, and just helping them in any way possible. So.
Hey,
Isn't it?
Tony, do you want to talk about just like what a hard money lender is and how they differ? Like, what are the differences from using a hard money lender compared to using a bank?
Yeah. So bank financing is all right. So I'll start with hard money lending. I don't want to bash the banks right out of the gate, but there's a somewhat negative vibe about hard money. I'm not sure why. I think it's one of the best investing tools that newer investors or even seasoned investors have to utilize. So hard money lending generally doesn't go against your DTI. It's not reported to the credit bureau as debt on your income, and there's lower credit score requirements for hard money lending as opposed to bank financing. Um, it is asset-based lending for the most part, although there are pre-requirements for um, newer borrowers or newer investors, and those would be 650 credit score and above. You have to have an LLC in place or fund an LLC, and obviously have some liquidity to get into the deal. We do not do 100% financing, although I get that question asked a lot. 100% financing, I don't even think exists unless you're going private money. But so the difference between hard money lending and the banks generally go off of DTI, tax returns, your income. So you have to have a verifiable, stable source of income. They want you to have a certain percentage down. They normally only will fund up to 70% loan to value, which means it's the entire loan if you're doing a flip. So it'd be the purchase plus the rehab, and then calculated against the after repair value. So it's a certain percentage of the after repair value they'll lend up to. I don't know any banks that are doing fix and flip loans now, unless you have a local bank that's willing to lend to you with that. So hard money is an amazing tool for fix and flips, or if you have private money, you can use that as well. I know a lot of people use private money to gap fund their deals with hard money if they don't have enough cash. What gap funding means is essentially you have a private money investor come in. We tell you as the hard money lender, hey, this is your down payment. This is what your closing costs are. You borrow the money from the private money investor, and that's gap funding to close the loan. You hold the note in your name, and then you would have a promissory note or a joint venture structure with that private investor. Most banks do not allow that. They want a seasoned balance in your bank account, and they also check volatility in spending as well. So if you're like, I used to buy and flip high-end mountain bikes. So I would always have like -4,000, +5,000 back and forth in my bank account. If I showed that to a bank trying to get a loan, they would want me to write a letter of explanation for all these different charges and why I'm frivolously spending this money or where it's going, right? For hard money lending, we don't care about that. I like to say hard money lending is kind of the Wild West of lending, because we can kind of play outside the lines a little bit. So those are pretty much the major differences between bank financing and hard money lending. That we don't discredit if you don't have any experience. We just require a little bit more down payment. So those are the big major differences. Anybody got any questions so far?
Do you want to just go through? We'll open it to Q&A, but first, will you just like go through what the kind of the process looks like?
Yeah, absolutely.
Okay.
So basically the short and skinny process is you find a deal, you get it under contract, or if you want us to look at a deal for you to see if you know it's something that we would lend on, we can do that. You send me a text message. It's funny because normal like lending companies or hard money lending companies, they don't really work off of texting or phone calls. It's all email based, so they have like a track record. Um, I take client calls at 10, 11, 12 o'clock at night sometimes. I had a client out in California most recently putting a flip in a contract, and they were negotiating till like 8:30, 9 o'clock at night. And I'm 3 hours ahead on the East Coast. So it's 11:30, 12 o'clock at night for me. And I'm like issuing pre-approval letters for this client as their bid keeps going up. So that was pretty funny, but you won't get that at a bank. I promise you that. Basically, the process looks like this. So you bring us your deal. We verify the address is in a population dense area. So when I say that, it has to be in or just outside of an area of 25,000 population or more. Either that's a city, town, county, whatever it may be. It's very difficult to get rural properties funded, meaning that it's kind of out in the woods, or Ashley's case in the mountains. Um, we won't necessarily touch those unless there's like a crazy spread in the deal. Like you bought it for 100 grand, it's worth 500,000. It's like 100 grand in repair, 50 grand in repair. We vet the deal, we vet you. So we verify your income, or not your income, but your credit score, your LLC, and whether or not you have enough cash to put down on the property. And then we issue you a pre-approval letter on that property to get it under contract. Once you get it under contract, you reach back out to us, say, hey, listen, we want to bid. We're ready to move forward. You send us the purchase contract executed in your LLC's name. We take that, we put it into the underwriting. You fill out an application which has basic information like your name, social security number, date of birth, your LLC information as far as EIN is concerned, data formation. And then we go into like your liquidable assets, so your cash on hand, your Roth IRA, stocks, bonds, crypto, whatever. You outline that, and then you outline the property details. We have an algorithmic thing built into the application that tells us whether or not that's a good deal on paper. And then we send you a term sheet based on the numbers that you put into that. Once the term sheet's signed, we send you a invoice to pay for the appraisal or BPO, and we're off to the races. That starts the process. We reach out to title. We give you the mortgagee clause to get insurance for a builder's risk policy for flips, and then a regular mortgagee clause for regular insurance if it was a buy and hold. And then that's pretty much it. Everything else is done through a portal. So we need driver's license, last month's bank statement, just general items, nothing too crazy. I had a client upload all his documents in like 10 minutes. So it can't be too difficult. With the bank, you'd be there for a week. So that's pretty much the general process. We close pretty quick. We can close within 7 to 10 business days sometimes. It just depends on how fast title is, and your appraiser and insurance company. But other than that, it's pretty basic stuff. It's really easy to get a hard money loan. Just like I said, just need the pre-requirements.
Okay, you guys, if you have questions, if you want to hit the hand raise button, because I realized that there's no chat in the Zoom, so I apologize. It must have been my fault. I didn't select a button or something when I set up the Zoom. But if you want to just raise your hand, and then I'll unmute you and you can go ahead and ask your guys' questions to Tony.
I think Pedro has a question.
Thank you, Ashley. Hi, Tony. Thank you so much for doing this.
Yeah.
How long would people have to pay back the loan? Like, what are the terms?
So terms vary. With a fix and flip loan, you're looking at 12 to 18 months, just depending on the size of the project. And then obviously you have your 30-year fixed loans for rentals and stuff like that. The fix and flip loan does not carry a prepayment penalty. So if you don't use the full 12 months, You can pay it off in, you can pay it off in a month and there's no prepay. But on a 30-year, you generally have either a 3-2-1 step down prepay, which means if you refinance in the first year, you'll pay 3 points, which a point is a percentage fee of the total loan amount. Second year, you'll pay 2. Third year, you'll pay 1. And then after the third year, the prepay goes away. And then you have a 5-4-3-2-1 step down, which is a little bit more of an aggressive one. That's if you're a little bit lower tier of a borrower, so below 720 credit score, you'll likely see a 5-4-3-2-1 step down. But you can also buy yourself out of that. I won't go into too much detail because that's some stuff that some people offer but don't offer. So I don't want to confuse you guys with that. But there is a buy down option where you can pay more to decrease the prepayment penalty. But anywhere from 12 to 18 months on the fix and flip side. And then you can do a 15 to a 30-year fixed on the rental side.
Actually, would a fix and flip fall under the Burr method?
It could, if you wanted to cash out refinance into a 30-year mortgage, absolutely. Those products we do have will help you acquire the property with 20% down if you're a newbie. So we'll fund 80% of the purchase price, 100% of the rehab, granted that it stays below the 75% LTV threshold. And then after the flip is done, we can cash out refinance you into a 30-year fixed loan. Yeah. So a Burr essentially.
Awesome. Thank you.
Yeah, absolutely. Great question. JP?
Yeah, hey, thanks. Can you talk a little bit about interest-only loans and I guess some pros and cons on those? For example, a 30-year with a 5-year fixed or something like that.
Yeah, so long-term loans is not in my wheelhouse, but interest only could be good for a couple of things. You're either in an equity-driven market or you're in a cash flow-driven market. Cash flow-driven markets I could see an interest-only loan working because you're not paying down the loan, but it's not increasing in value, and interest only should only be held for a couple of years until the assets stabilize. Then you can refinance into a P&I loan, which would be principal and interest. They do have, there's so many different loans out there, but I'm pretty sure that they have a 5-year interest only. And then after the 5th year, it matures into a 30-year or a 25-year fixed principal and interest loan. So I don't know if that really answered your question, but generally speaking, interest only loans will be for fix and flip loans. You're not going to have a principal pay down on the loan in any fix and flip loan that I know of.
Okay, and what about short-term rentals, I guess? Is that how does short-term rental qualify for as far as the income on a property?
Yeah, great question. Generally speaking, there are some lenders and banks out there that will lend on short-term rental properties, but it's based off of cash flow and verified rental income. So they like to see that the property has a track record of being an Airbnb or a income producing property, and then they'll lend based off of that cash flow amount up to a certain amount of the cash flow. I know most banks require now 6 to 12 months of previous Airbnb income. So you would have to get a profit and loss statement from the previous owner, submit that to the bank, and show them, hey, this property makes money at this new purchase price. I don't know if that answered your question. I think he's muted.
Yeah, that helps. Thank you.
Okay, absolutely. Paul, what you got?
Well, my question is, what kind of seasoning do you have to have if you're doing a Burr refinance? Do you have to have it rented for 6 months, or can you just have it rented for a month, or just about to be rented, or exactly what are those requirements?
Yeah, great question, man. So for the Burr method, my company doesn't require a seasoning period, but we will we'll lower your LTV by probably around 10%. It's really hard to say because it's kind of particular to each deal, but generally speaking, 10% less on the LTV mark, which we lend up to 75% LTV on a cash out refi. So you'll either take a 65% or 70% LTV cut just because you didn't hold it long enough. But seasoning period starts the time of closing. So if you're burring a property and general rehab time from start to finish is anywhere from 3 to 5 months. A lot of people say that they can do it quicker. It just depends on how like involved the rehab is. Is it a full gut or is it just carpet and paint? Or is it just cosmetic? If it's that case, then you're only going to probably have it for, a month or so, and then you'll take the LTV cut. But if you're a normal flipper, or you get into a normal flip that is a full gut, like you're down on the drywall or maybe rehabbing the entire property, those take a lot of time, and your seasoning period is calculated from the time you close to the time you're ready to refi, including the rehab time. So it's very dependent on how long you've held it as to what LTV you get on the cash outside. But if you're going to a bank, which you're going to have slightly lower interest rates, but you're going to be in a full documentation situation, which is tax returns, W-2, verifiable source of income, liquidity, assets, credit score. I mean, the list goes on. It's going to take you longer to get that refi done. But the trade-off is you get a little bit lower like interest on the property than you would with a regular hard money lender that doesn't require all that stuff. But some people just like the peace of mind and the ease of working with a hard money lender to cash their property out, especially if they already have the fix and flip loan with them. We can just transfer the loan, get a new appraisal done, and it's already done. We already have all your documentation, everything for closing.
Okay, great. Thank you.
Yeah, absolutely.
I had a question.
Hey, how are you?
Hi, how are you?
Good.
Good. Thank you for joining us tonight.
Yeah, of
You
course.
said your episode was number 147. Is that the right one, Ashley? I don't know if you were able to verify that.
I think so.
Yeah, it was a correct one.
Okay. And on that episode, I know they usually do a deal review, so you just wanted to make sure that was in the episode.
Yeah, I think we did do a deal review in that episode, right, Ashley?
Yeah, we did, but please do not ask me what deal it was. If you
Oh, well, yeah, I couldn't remember either.
I think we did one of your, I don't know. Yeah, but it was one of the flips in Tampa. I'm pretty sure.
Okay.
Oh, yeah.
Now, as far as the credit score goes, when somebody makes a profile with a hard money lender, like how long does that credit score last? Or is it like, if you did a deal every 3 months, would that be a hard pull on your credit?
Yeah. So, I mean, great question. These are all amazing questions. Your credit score or your credit report is good for 90 days with a hard money lender. But we don't pull. So, and again, there's another difference between regular banks and hard money lending. A bank will pull your credit score to give you a pre-approval letter. We give you a pre-approval letter, then pull your credit. So I'm not tagging. If I give you a pre-approval letter and you don't get the house, no harm, no foul. Go on to the next one, right? But when you do get the house and then you do the application and you do this and you sign the term sheet, at the bottom of the term sheet, it says you allow us to pull background and credit, full background and credit score check across all 3 bureaus. When you sign that is when we pull credit. And we can even work with you, be like, hey, listen, I'm paying off some credit card debt. I got this coming off, a loan being paid off this month. It's going to shoot back up. We'll work with you and say, hey, listen, yeah, we'll pull credit 5 days before closing instead of, right now when we're, 14, 20 days out. So.
Okay, that's good. I actually talked to a hard money lender by accident last week.
Oh, nice.
it was a great experience actually. But one of the things they said was they would include like any work that I did to my personal home as experience for like a fix and flip, because they required like 3 examples of homes or properties that
Wow. Okay.
is that something that you guys do, or would it need to be like what does that number look like, or what is that experience needed to not be considered a new lender or borrower?
So if you bought a home and did a live-in flip, we would count that. As long as you executed and sold the property within 2 years
Mhm.
and you sold the property for a profit, then we would count that as experience. But if you currently reside in the home that you did work on, then we can't count that as experience, no. And we don't need, I'm going to be very blunt. With a new investor, you have to have a strong liquidity position and a great credit score to get a first-time flipper loan with us. We want to know that you have the capital to back yourself if something goes wrong, and we want to make sure that you're making all your payments and stuff, and not slacking on credit card and regular loans and stuff like that in the past. And then it's 25% down on the purchase price of the property. You don't need to show any kind of experience for that type of loan. But we do have tiers. So when you have your third flip completed or your third investment completed, then we move you into a 15% down bracket. And then once you reach deal 6, we put you into a 10% down bracket. So there's different tiers and stuff, but we don't require experience for first-time flippers. But great question. I've never heard of a hard money lender that would use work done to your primary residence as experience. That's kind of interesting.
Yeah. They said as long as you can submit pictures of before and after, they would count it as experience. But thank you.
Wow. Yeah, absolutely. Great questions.
So kind of along that same line, my question is between, 1998 and 2013, I did 4 live-in and flips and 1 rental where I remodeled them. One was in San Francisco and the others were in Maryland around the Baltimore area. And I lived in it 2 years. I did the house back thing, 2 years at least, and usually new kitchen, new bathrooms, and then, paint or whatever cosmetics, and sold it. So I didn't have to pay the property tax, capital gains. So would that put me into one of your other tiers? No.
No, it has to be within the last, it has to be within the last 3 years. And that's pushing it. Normally it's 2 years. We can go up to 3.
Okay, great.
Yeah.
I have just 2 quick questions.
Yeah,
First one is you spoke about LLCs earlier, and as one of the topics that Ashley covered in the last class last week. The LLC that you're looking at, is it a new LLC that we're forming to purchase that particular property, or is it the LLC that you operate as for your business?
It doesn't matter. Whatever LLC you want the property to reside in. I do know people that execute LLCs for each individual property that they do.
Okay, I know people like that too, so I was just questioning.
Yeah, and myself, I have 1 LLC, and we have, I think, 5 current projects going on. But I'm not holding them; I'm flipping them. So what I did was I put a $2 million limited liability policy, insurance policy on my LLC, and then I move properties in and out of that insurance policy as I flip and sell them. I think that's a very smart way of doing it, rather than having 4, 5, 6 different LLCs, or just creating an LLC every time you get a flip on a contract.
Does that method have a name? What you just described?
No, and it's kind of interesting because a lot of people haven't figured that out yet. So every time, just
it's the first time I've ever heard this, but it sounds like
so for the whole crowd, when you do a fix and flip, the lender, if you go through a hard money lender, they're going to require what's called a builder's risk policy. Essentially, it's a policy that ensures the project that's under construction They're generally a little bit more expensive than a regular, actually a lot more expensive than a regular insurance policy. But it protects you from anything that, say that you're replacing a wall and you nick a wire and the whole place burns to the ground. Well, your policy is going to cover that for the full rebuild costs. What you are going to also have on that policy is general liability insurance, to the tune of 500,000 per property, and then $1 million if it's over 500,000, under $1 million. To have that liability insurance added to your insurance policy for the builder's risk quote, it's anywhere from like $200 to $400 added to the premium of your property or your policy, having that general liability insurance. So what I've done is, instead of paying that every time I get a flip on the contract and do a builder's risk, I just got a $2 million limited liability policy that covers all my properties, and I can move them in and out of that policy whenever I want. And it only cost me $480 for the year. So instead of paying $200 to $400 per property that I flip, I only pay $480 for the year, for 40 or whatever it was. And that covers the whole spectrum. And hard money lenders will accept that as general liability policy for the property. So therefore you can exclude it from your builder's risk policy and not have to pay the extra charge. Okay. I do not know what that's called, but I don't see it often, which is kind of crazy because I talk to a lot of people, and when I bring it up, they're like, "Oh my God, I never even thought of that." And I was like, "Yeah, I did. I'm a penny pincher, so I found a way to pinch a penny, and I made it. I guess I should coin a term for it and write a book and do everything else that other people do when they figure out something, right?"
This could be like an episode of a podcast, but
yeah, right.
My last question was regarding the qualifiers. You mentioned the two top strong qualifiers are the credit score and strong liquidity.
Yes.
What do you guys consider like a perfect credit score to work with, and what is an example of like a strong liquid asset?
It's 720 and above.
Okay.
Rates generally don't change if it's over 720. Someone came to me the other day. I was like, "Well, don't I get a better rate if my credit score is over 800? I gave them a tiny golf clap because that's impressive. But I had to tell them, like, hey, it doesn't matter if you're 721 or an 819 or whatever the heck this guy was. You still pay the same rate. I'm glad you have a great credit score, and that's amazing, but it doesn't change how we view you on the underwriting purposes. And then strong liquidity, I'm looking for 25% down. So if you're a newbie, I want 25% down of the purchase price in an account, plus 6 to 12 months of interest reserve, plus a 10% rehab contingency. So if you have a $60K rehab, I want to see $6,000 extra dollars that you can put into that rehab in case, something happens. So that would be a quote unquote.
Say that last part one more time. I think someone was talking, so I couldn't hear.
Yeah. So the last part is about the capital. So I want you to have 25% down of the purchase price of the property in an account. I also want you to have 6 to 12 months of interest reserve. So whatever your interest payment is on that property, I want you to have 6 to 12 payments of that as capital in your bank account, and a 10% reserve contingency for the rehab. So if you have a $60K rehab, it would be $6,000 in cash reserves. That would be a good liquidity position.
Okay, so basically, I'm a real estate agent, so we call that post-close liquidity, basically.
Yes.
Sounds good.
Yes.
Thanks. That was pretty helpful.
Yeah, absolutely. Great questions. Do we have any other questions?
Yeah, does anyone have any questions? Since we don't have the chat, you can just raise your hand for the new people that just came in.
Will
Or
we
you can
get
Yep, go ahead. Or you can just unmute yourself.
your contact details? We got some deals to text.
Okay. I gotta ask Ashley if I can drop that hot heat.
Yeah, I don't care.
Okay. Awesome.
I currently actually just probably, what was it, Tony, 2 hours ago, I closed on a line of credit with Tony. So
yeah,
I personally used him and have gone through the process and everything. So yeah, if you guys find benefit from him, I would be more than happy to have him share that with you guys.
Yeah. So it's, so I'm really active on Instagram. That's probably the most active platform I'm on. It's Tony Michael REI on Instagram, and it's MICHAEL, spelled Michael. If you guys have any other questions, or if we get off the call and you guys think of something, just reach out to me there. You can shoot me a DM. I'll be happy to answer any questions, or if you guys have any deals that you want me to analyze for you, I'd be more than happy to do that for you guys. Ray, it looks like, has a question.
Yeah, hey Tony, really quickly, you're talking about strong liquidity position. Somebody using a HELOC, does that count? Will you look at that as well as reserves that you can tap into, or is that
Absolutely.
seen separately?
Absolutely. As long as the HELOC's closed and ready to be drawn from, absolutely, we'll look at a HELOC. And that's another thing about hard money, right? So back into the hard money thing. I know I keep going back, but you guys are bringing up great questions, which is awesome. We don't care where you get your money from. I always make this joke, and it's funny to some, maybe not funny to others, but I'll say it anyways. We don't care if you sell drugs on the street and get money from it. It all spends the same, and you can use that money to close on a deal. I had a guy that, what was it? His mom gifted him a certain amount of money that like into his bank account, and he used that to fund his deal with. Like we literally don't care where the money comes from. You can liquidate crypto. It doesn't matter.
Awesome. Thank you.
Yeah, absolutely. Dana's got one. Dana, I think, oh, there you
Hey, I was sorry. I'm at work
Yeah,
with
no
my little
worries.
stuff right now.
go. Thanks for tuning in.
You may have said it because I've been jumping on and off this call, but how fast? Like, because I'm just starting to look. I'm like new, still trying to kind of find my market. How fast is the process of getting the funds to purchase, or just getting set up with the deal with you guys? I guess just starting from day one.
Yeah, if you're talking about closing time, we can close in 7 to 14 days.
Is that like from how fast I give you the information, like my information?
No, so it's as soon as you give me all your information, we start underwriting. Especially, excuse me, if you have a deal under contract, you've already filled an application. The majority of the hiccups that happen with closings is not due to the hard money lender. The hard money lender only ever really needs like 2 to 3 business days to do the underwriting on your file. It's doc collecting, so people getting in all their documentation for the underwriters to look at and satisfying the list of needs for documentation. It's title company is generally the slower of the bunch. Appraisal timeline. So if you're in a really hot market, good luck getting a appraisal done in Austin, Texas in under 2 weeks. It's not happening right now. So your closing window automatically adjusts just for the appraisal timeline. You're out 21 days, 30 days sometimes. I don't know if that answered your
Perfect.
question.
Thank you.
Okay, awesome.
No, it does.
Yeah, absolutely. I think you guys can unmute yourself. Pedro, do you have a question?
Yeah, I think there's still some hands up.
Yes, I still have one last question.
Yeah.
Yep, go ahead.
And then Daquan, I think you're next. How many months of bank statements do you require for your vetting process?
2 months last 2 months bank statements.
Okay.
And if you go over, if you like went under contract to 25th and you're closing like the next month on the 10th, we would need that overlapping bank statement as well.
Okay. And if you get money, like a gift money from a parent to, for post-close liquidity and whatnot, or for general assets, do you need like a gift letter to show where that money came from?
Nope.
Okay.
We do not. Nor do we have to have funds seasoned as well. If you guys don't know what that means. So sometimes a bank will require the funds to sit there for 20, 30, 60 days sometimes, just to make sure like you didn't like hit the lottery and you're going to blow all this money or whatever. We don't care about that. As long as the funds are in the account prior to closing, that's all we really need.
Question, just a clarification question. So when you use a hard money lender, I've seen a lot of deals or a lot of offers that say like cash only. Does that mean that you can go into that deal knowing using a hard money lender that the option to pay cash is there?
Okay, so that's a slippery slope. That is an amazing question. The general terminology of cash just implies that it's going to be sold as is, no contingencies, right? That's what a cash offer is. That's the feasibility in a quick or close time, right? Because you don't have to wait for funding, you don't have to do underwriting, any of that stuff. You just have to wait for clear title, which generally takes anywhere from 5 to 7 days. Our offers are same as cash with an appraisal contingency. Generally, by the time the appraisal gets back, we're pretty much ready to close. If the borrower's like at it, on point, getting everything done, getting insurance lined up, because we're as quick as the borrower is. If the borrower is slow, then we're slow. If the borrower is quick, we're quick. I write on my pre-approval letters, hard money, same as cash. There's just that's that fine line with an appraisal contingency. Is hard money lending cash? No, it's not cash.
Okay.
But we can trick people. No, I'm just kidding. Don't do that. It just boils down. Like some people will accept that as a cash offer. Some people won't. What we like to articulate is nobody's bringing a briefcase of cash to closing. So it's a wire always. So it doesn't matter who the end lender is or how the funding source gets there. It's just ease of business if it's an all cash offer, which I understand too. So we cannot be a cash offer, but we can be sort of a cash offer.
Okay.
I wish I had a better answer for you, but
No, it's a complicated answer. I get it. I understand.
100% complicated. And like I said, some people do accept that, some people don't.
And just real quick, when this might be a stupid question, but what are you
There's
guys?
no stupid questions, brother.
What are you guys appraising? Because most of the time the property is already deteriorated or needs to complete is a complete gut job or something like that. So what are you looking for in the appraisal?
Great question. That's an absolutely great question. So there's a 2-part appraiser. It's called a 1004 as is / ARV. That's the type of appraisal that we require. So when we send the appraiser out, they are appraising the property at its current value and its current condition and current state at the current state of the market. And they are also appraising at the same time for the after repair value based off of your rehab budget. So we, as a hard money lender, we require you to fill out a rehab budget articulating what you're going to be completing on the property. Are you putting Formica countertops in? Or are you putting quartz countertops in? Because there is a difference in after repair value between those 2 items. When the appraiser's out there, he has your rehab budget in front of him, and he says, "Okay, this kitchen's getting brand new shaker style cabinets with European, soft close hinges, granite countertops, all this other stuff, and that increases the value of the property. And then that's how they give you the after repair value. But the as is value comes in because we are lending on the purchase of the property. So we don't want to be upside down on the purchase of the property for the beginning of the deal. So we will only lend up to 90% of the purchase price or as is value of the property.
So there could be an opportunity of you walking into a deal with equity sometimes if you get.
Absolutely. I see it all the time. Yep.
Wow. Okay. Interesting. Okay.
Great question. That was not a stupid question. That was a great question.
For the rehab budget that you have to submit, are there any resources for that, especially for new people? Is that something that you work for with contractors? Oh, see, that's why you analyze the deal, right? When we text you.
Absolutely. And I have a rehab budget that I can share with you guys. If you're interested, just hit me up on Instagram. I'll be happy to email it over to you. I know Ashley also has a great one too that she's been working on real hard. Mine's better than Ashley, but I won't tell her that. The resources.
Actually, Daryl made mine, so he's really upset with you right now, Tony. You heard that?
Yeah. I'm sorry, Daryl. I don't mean to hurt your feelings, buddy. Dang, Daryl. As far as contracting goes, like making your rehab budget, you can have them do that, but I think you're going to be a little bit more transparent with your numbers and more reserved with your numbers, because if they know that you have like a floating 80 grand budget, they're going to always shoot for the top end of that budget because they want to make more money if they know that you can pay that. But if you come in and say, hey, listen, we need to do this for 60 grand, what can we get for that? Then that makes a little bit of a difference as to, you know, how much they're going to charge and what materials are going to go into. So I hope that answered your question.
It did. Thank you.
Awesome. Actually, I think we have a hard stop at 7:15, right?
Yeah, just because I need to call my kids and say goodnight to them and eat
Oh,
some food, because we are all back on a call in 45 minutes. So to do our normal boot camp call. But Tony, thank you so much for coming on. I really appreciate it.
thank you for having me. It was a pleasure.
So you guys reach out to Tony if you guys have more questions, or if you want to talk to him about maybe doing some hard money lending. He's definitely a great resource. I just used them and everything went great. So
awesome. Thank you, Ashley, for the kind words. I appreciate you guys. Thank you guys for tuning in and listening to me banter for the last hour. I hope I added some value to you guys. And if you want to follow me on Instagram, it's Tony Michael REI. I'll be happy to answer all your questions there.
Thank you.
Thank you so much.
Thank you guys so much. We'll see you in a little bit. Bye.